Introduction. Hello and welcome to this video on the Consumer Price Index, or CPI for short. In this video, we'll be discussing what the CPI is, how it works, and why it's important. What is the CPI? The CPI is a measure of the average price of goods and services purchased by households. It's like a basket of goods that a typical household might buy, such as food, housing, transportation, and entertainment. The CPI measures the change in the cost of this basket of goods over time. How does it work? Let's say that the CPI is 101 year, and it increases to 110 the next year. This means that the cost of the basket of goods has increased by 10%. This means that prices have risen, and your money can buy less than it could before. The CPI is calculated by comparing the cost of the basket of goods in the current year to its cost in a base year. Why is it important? The CPI is important because it's used to track inflation over time. Inflation is the rate at which prices for goods and services are rising. If the CPI increases, it means that the prices of goods and services are rising, which can lead to higher inflation. The CPI is also used by policymakers to make decisions about interest rates, taxes, and government spending to control inflation. For example, if the CPI is higher than expected, the Federal Reserve, which is the central bank of the United States, may increase interest rates to slow down economic growth and combat inflation. Impact on the USD currency. So how does all of this impact the value of the USD currency? The CPI can have an impact on the value of the USD because it's closely watched by investors and policymakers as an indicator of inflation. If the CPI increases, it can make the USD more attractive to investors seeking higher returns on their investments, which can lead to an increase in demand for the currency and a rise in its value. Conversely, if the CPI is lower than expected, it may lead the Federal Reserve to lower interest rates to stimulate economic growth, which can cause the USD to weaken as investors may seek higher returns elsewhere. Conclusion. In summary, the Consumer Price Index is an important economic indicator that measures the average price of goods and services purchased by households. Changes in the CPI can impact the value of the USD currency, as it's closely monitored by investors and policymakers. Understanding the CPI is important for anyone interested in the economy, investing,